When individuals consider risk management in the context of trading, they naturally focus on the danger of losing money. However, traders might take many different paths before arriving at their ultimate realized profit or loss destination. Your next trade might be your last if you don't manage your trading risk properly. To avoid becoming a victim, join us today as we teach you trading rules and risk management strategies that will minimize your losses. With that being said, let's get started. Bright. Rule 6. Be risk consistent. Most beginners will raise the size of their positions as soon as they start to make money, which is one of the most common methods to wipe out your account. Maintain a constant level of risk. Don't become too self-assured or risk-averse.
Noted.
Just because you've had a few successful deals doesn't indicate the next one will be as well. Do not become overconfident or risk-averse, since this will cause you to change your money and risk management policies without justification. When it comes to being overconfident, it has to do with being self-consciously emotional, which might impact your trading judgment. We'll go over why staying emotionless is a crucial trading rule, so sensitive traders keep an eye out. Rule 5. Consider your risk tolerance. Before you begin trading, you must first assess your risk tolerance, which is based on your age, experience, the amount of money you're prepared to lose, and your investment objectives. It's not only about sleeping better at night or worrying less about currency changes when you know your risk tolerance. It's about feeling in charge of the situation, since you're trading the appropriate amount of money in connection to your particular financial condition and financial goals. Having an accurate understanding of your degree of comfort with risk enables you to more effectively plan your investment strategy across the board. For instance, if your risk tolerance is low, your investments will be created in a prudent manner and will consist of a greater number of low-risk assets and a smaller number of high-risk ones. Rule 4. Don't trade emotionally. As human beings, each and every one of us is capable of feeling certain emotions. When it comes to trading in stock markets, on the other hand, it is beneficial to stay away from them and use a method that is more disciplined. Undeniably, the most challenging aspect of trading is controlling one's emotions. In the trading business, it is a truth that if a successful trader hands over their method to a novice, the beginner will lose all of their money because they are unable to keep emotion out of their deals. That means they can't accept losses when the trading system tells them to exit. And they also can't take winnings since they want to stay on for higher gains. That's why it's critical to use a tried and true trading strategy and stick to the guidelines set out by that strategy. Enter the trade when the system tells you to, and exit when the system tells you to. Don't make assumptions about the system. So basically, when it comes to trading, your emotions should be treated the same way you treat your water, carefully stored in a bottle. Before I continue with this video, kindly subscribe to our channel to motivate us to come up with more content. Rule 3. Minimize losses. One rule of thumb for day traders is to never risk more than 1% of their assets on a single deal. It is often referred to as the 1% rule, and we will explain exactly what it is and how it works later on in the video, so keep watching. That way, even if you have a streak of losses, which is always a danger given the random distribution of results, your portfolio will not suffer too much harm. With a winning trading technique, a 10% drawdown on a trading account may be overcome. However, the greater the decline, the more difficult it is to recover. You only need a gain of 11.1% to break even if you lose 10% of your money. However, if you lose 50% of your money, you'll have to quadruple it to break even. The most important aspect of any trading strategy is to minimize losses. Rule 2. Don't trade money you need. Traders, particularly those just starting out, often disregard this guideline since they don't believe it will apply to them personally. You wouldn't bring your whole cash to a casino to bet on black, would you?
It's not smart.
The same goes for trading. Don't jeopardize your life savings by dealing with money you can't afford to lose. So why do we say that? First, because you run the risk of losing all of your trading capital, and second, because trading with money you rely on to make a living puts you under more strain and emotional stress, which impairs your judgment and makes it more likely that you will make a mistake in your trading. Rule 1. The 1% rule. An account with less than $1,000 and it should be avoided because of this rule. A $30,000 trading account isn't going to limit you to only $300 worth of stocks, since that's just 1% of $30,000. With leverage, you may put all of your money into one transaction, or even more if necessary. Using the 1% risk rule implies that you use risk management measures so that you do not lose more than 1% on any one investment. It's impossible to win every deal, and the 1% risk rule helps safeguard a trader's equity from big losses in bad markets. Losing 100 trades in a row at a risk of 1% of your current account balance is all it would take to wipe out your whole account. It would be much easier for inexperienced traders to succeed if they followed the 1% rule.
I see.
Even while risking 1% or less on each transaction may seem little to some, it has the potential to provide substantial profits. In order to get a profit of 1.5 to 2% on a successful transaction, you need to risk 1% or more on each deal. Even if you only win half of your transactions, you may still earn a few percentage points each day by placing multiple deals a day. This brings us to the end of today's video on trading risk management. If you want to understand risk management better, check out our video on risk management framework. What is risk management? Thank you for tuning in and enjoy the rest of your day.